3:45. It's good to see everyone. Welcome back to another fantastic week in economics. Let's see, where have we been so far? So we spent a lot of time on expenditures. We talked about how do we necessarily spend the money, right? But we haven't talked as much about collecting the money. So government has to get their money from somewhere. One of the biggest forms of revenue for the government is through taxes. So today we're going to start into our journey of taxes by talking about different types of tax systems and tax incidents. After that, we have a variety of different chapters that we're going to cover afterwards, talking about more nuanced aspects of taxes and digging directly into some specific ones. So today I'm going to kind of give a general overview. We're going to go in depth into examples related to income taxes so that you can get a basic idea of how everything works together. And then what are we going to do after that? Talk about tax incidents. So we figure out if we need a tax in the market, is it better to put it onto the consumer or onto the producer? Okie dokie, let's go ahead and get started. Over here. Cool. All right. So tax systems. What can I say about taxes? They're terrifying. They're kind of exciting to study if you find this sort of thing interesting, and society's never going to agree on them, right? You can lay every economist you've ever met just end to end, and you're never going to reach a conclusion. And that's because there's a lot of very minute but nuanced differences in what people believe are the optimal rate of taxation. So this is something that we need to kind of think about. Well, first let's talk about the US system, or think about the US system in general. So our taxes, you're taxed really at two specific different levels, kind of three. The first is going to be the federal government. So how much does the federal government raise? Well, as we can see on the leftmost pie chart, the majority of the money for the federal government actually comes through individual income taxes. That accounts for about 44.7% of their tax revenue. Now, Social Security contributions, that's another 36%. But corporate income taxes are only 11.2. That's actually surprisingly low. People find that very interesting to see. Now, that's the federal level government, and they use a different type of toolkit or set of tools than state and local governments. So state and local governments are much more likely to raise money through property taxes. So property taxes are ones on your home, or like where you're living, or any land that you own and any structures upon that land. And that accounts for a lot of the money that goes to state and local governments that in turn goes to pay for schools. Most state governments also have individual income taxes. There are 5 states that do not. So Texas, Florida, I don't remember the other ones off the top of my head. So there's some that do not have an individual income tax, but they do have consumption taxes. So a lot of taxes related to what you are consuming, such as gasoline and things like that. We also have a bunch of excise taxes, for example, the taxes on cigarettes that happen at the state and local level. Together in our total government picture, which we see on the rightmost portion, we see that about 37% of tax revenue for governments comes from individual income taxes. Then another good hefty chunk comes from consumption, and then Social Security. Okay. So let's go through kind of a list of what types of taxes there are. And this is not even a full list in and of itself, though it is fairly comprehensive. So the first is going to be payroll taxes. You're probably familiar with payroll taxes. This is money that goes to Social Security. It's money that goes to Medicaid and Medicare. This is money that gets taken out of your paycheck and is matched by your employer. So they actually, for every dollar you put in, your employer also puts a dollar in. It goes to the federal government. Okay, so that's our payroll taxes. Now, those have a very specific purpose that they tend to go to. Individual income taxes are not the same way. So this is the tax that's paid on your individual income that you accrue through the year. You make some money and you have to pay a portion of that to the government, both the federal government and in the state of Illinois, the state government, right? So these taxes paid on your individual income are not slated to any one specific program or thing. Government can kind of use it as they need. There's also capital gains tax. So you're going to own a lot of assets in your life, or at least I'm going to assume so. You're going to own paintings and maybe expensive cars and expensive houses, and you're going to have stocks. And these things are going to appreciate in value, which means that they're going to be worth more over time. Well, for all that additional earnings that you get when you would eventually decide to sell it off again and notice that the value has appreciated, that difference of how these things have grown that's going to be subject to a capital gains tax. Then we have corporate income taxes, very similar to individual income taxes, but these are on the earnings of corporations instead of individual earnings. Then we also have wealth taxes. So wealth taxes are taxes that are paid on the value of assets. So, the things that you have, the stocks, your estate, these can be held by a person, a family, or a trust. Then we have property taxes. So these are ones that are these are a wealth-based tax that's based on the value of real estate. So both the land that you own and any structures upon the land. Okay. Then we have estate taxes. This is also a form of wealth tax. This is just the tax on the estate that you leave behind in the eventual event of your death. Then we have sales taxes. You're probably pretty familiar with these. You have them on almost every good. I think in the state of Illinois, you don't have them on some sort of goods that are considered necessary items. So I think it's like non-hot, so food things that you can purchase that are not hot and are considered cold substances. So those do have reduced sales taxes or no sales taxes at all, depending on what category they're in. Then we have excise taxes. So these are ones that are on very specific goods. For example, excise taxes on cigarettes. The reason why they're there is both to raise money and for the purpose of being able to have this revenue source from a good that we would like people to use less of. Another good that typically has an excise tax is gasoline. So think about every mile that you drive or every bit of gas that you use in your car. There's some portion of that that's going to end up going to the state. The purpose of this is to be able to pay for roads. So then that's kind of interesting. So we do see excise taxes. So see, there are a whole bunch of taxes in our government toolkit to be able to try to finance different projects. So with that, let's think about how we compare to other countries. So if we go back a couple slides, we see that in the United States, we tend to have about 37% of individual income taxes, or the revenue from individual income taxes, about 24% from consumption, 23% from Social Security. We see fairly similar things across OECD nations. A lot of countries actually have less individual income tax revenue, but have more consumption taxes, so sales taxes and excise taxes. And they tend to have a fairly large Social Security contribution. But this can be very different among the countries included in OECD. So these are just, developed nations. For example, we have Norway, which has a large portion of money that comes from Social Security contributions, while on the other hand, we have Denmark, which barely gets any Social Security contributions whatsoever. Instead, they have individual income taxes on everyone that they use to fund these programs. So how to compute the tax base? I'm going to talk about a couple key terms here, and then we're going to go and look at kind of what the equation is for being able to work through and calculate your tax base. So we're going to focus on income taxes for the next few minutes. Income taxes are assessed or they're assessed on your adjusted gross income minus your amount of deductions and exemptions. What does that mean? Well, gross income is the total amount of money that you've made, right? It's from all the different sources. It's the ones that the money that you've made from work, maybe from consulting, maybe from an honorarium for a speaking event, any sort of thing that you could have that you bring in money in a typical year. From this gross income, we calculate adjusted gross income. So this is your gross income minus certain specific deductions. For example, if you put money into your HSA, this is pre-tax money. So that goes before we start doing any other calculations. Contributions to an IRA, these are also pre-tax. So they're taxed at the time where you take them out later, not when you originally put them in. So these are taken out before we start any other calculations. From there, we get our adjusted gross income. From our adjusted gross income, we can take a standard or itemized deduction. We're going to talk a little bit more about that. Then we get our taxable income, which we have to put through our tax calculation, where we have to calculate our average tax rate and our marginal tax rate and understand what those key pieces are. Oh, and then from there, we understand what taxes are owed. We compare this to our withholdings. We take away any credits that we might have. And then we eventually get what our tax payment or tax refund should be. Okay, so taxable income is just the amount of income left after we subtract all the exemptions. Now, there's a lot of adjustments that could happen, right? I mean, there's so many. Let me just go ahead and think of a few off the top of my head that I just randomly wrote down. Some might go to retirement savings. Some might go to alimony. You might have health insurance premiums because you're self-employed, or maybe you're company actually ends up paying a lot of it. Maybe 1/2 of the payroll taxes are self-employed. Maybe there's an educator expense or an interest expense that you pay on student loans. Maybe there's contributions to an HSA account, like I just said, because remember in our last episode, we looked at the difference in between HSA and FSA. Maybe there's expenses for your job. Maybe there's a lot of stuff that you have to buy for work that you cannot reasonably use for any other purpose. Maybe there's interest you paid on student loans because, by the way, the interest paid on your student loans is tax deductible. Please, when you go to the real world and you're paying back your student loans, keep track of that. So don't pay more on taxes than you have to. Get the cuts where you can. Paying student loans is expensive. Whew, okay. So let's keep, we're still going on this tax base, right? There's a lot of words to learn today. So to form the adjusted gross income from gross income, we subtract out different exemptions and deductions, right? Exemptions is a fancy word for saying a fixed amount a taxpayer can subtract for dependent members of a household. So this is the money that you deduct for your kids or for maybe elderly relatives who can't take care of themselves, people who may have mental disabilities or physical disabilities that make them unable to provide for themselves. These are different dependent groups of which you can have a reduction in your tax bill because of, right? Taxpayers can take one of two types of deductions when we get to the point where you're trying to figure out your deduction. The first one is a standard deduction. So this is a fixed amount or a fixed number that the government comes up with every year. And you can subtract that amount from your adjusted gross income for your taxable income. And it's typically fairly large. And it goes up depending on the number of people in your household. Most people use the standard deduction. Very few people itemize, but sometimes that might be the right choice for you. Itemized deductions are alternatives to standard deductions, whereby you as a taxpayer, you might be able to deduct maybe the money that you spent on various expenses and charitable contributions and interest on your home mortgage and a wide variety of other things that might be considered tax deductible. So you have one of these two choices. You've probably heard these buzzwords a lot if you haven't already thought about it when you've put together your own taxes. This is your standard and itemized deductions. Once we subtract out those, then we understand a little bit more about your tax base, right? But allowable deductions for claiming, if you decide to go the itemized deduction route, it can be a lot of things. Let's say that you have a lot of medical bills, like you got hit by a car or something just atrocious has happened in your life. Then if your medical or dental bills exceed 10% of your adjusted gross income, then you can deduct some of these expenses. Okay, you can also deduct maybe taxes that you've paid to states or local income taxes, because if you've already paid a lot of taxes to the state or local entity in which you live, that adds up, right? And it's something that needs to be considered when calculating your federal tax bill. Then there's interest paid on investments and home mortgages, gifts to charity, casualty and theft loss. So if everything in your house gets stolen, you at least can deduct it on your taxes, right? Reimbursed employee expenses, so on and so forth. So there's a couple other major pieces within our calculations. We have tax credits. So you've probably heard a lot of the time, like, is this a deduction? Is this a tax credit? You totally want a tax credit. I think we have the earned income tax credit, which a majority of the people in the class probably get. There's a lot of other different types of tax credits that you can have. And these are amounts by which taxpayers can reduce the taxes that they owe to the government through different types of spending. For example, you can get a tax credit to help pay for childcare or something else like that, right? Then there's different withholdings. So you probably also know about withholdings because you get your pay stub at the end of every month. On your pay stub, you have your pre-tax amount of money, then you have your federal taxes withheld and your state taxes withheld. These taxes withheld meant that this money is going to the national or state government and where it'll stay until you calculate your tax bill at the end of the year to find out if you owe more or if you should be getting a refund to get some of those withholdings back. Speaking of refund, refunds are just the differences in between this amount withheld and your taxes owed. If the amount that you've withheld is more than your actual tax bill, then you get a refund back at the end of the year. So let's think about the argument of deductions versus credits. Actually, no, I've changed my mind. We're going to start with seeing at least the steps of this. So this is my very poorly drawn thing. Where's my pen? Haha, I found the pen. So let's talk through a little bit of the steps of how we calculate our tax payment. So step one is gross income minus deductions. So let's just say step one. Well, I'm going to give you a fake hypothetical situation. Let's say that you've graduated from this class and you just become the best econ person on earth, and you're going to start your new job, and you're going to start your new job making, I don't know, let's say $85,000 a year. That's pretty good. That's a pretty good starting salary. I'd be pretty happy with that, right? Okay, well, after that, we need to go ahead and figure a couple things out. Let's say that maybe you put $2,000 into your HSA. So remember, HSA is pre-tax money. So you'll get taxed on it later or when it comes out. Or do HSAs? Doesn't matter. Money goes there in a pre-tax form, right? Okay, cool. So that means that our adjusted gross income is just this gross income minus the deductions of things that will either be taxed later or untaxable income. So then we have $83,000 for our adjusted gross income. Now we have two different options. One option is the standard deduction. The second option is to itemize. In most examples I'm going to give you is the standard deduction. So in this one, let's go ahead and minus out 24,000. And I'll normally give you a chart that gives you the standard deduction for how many children people have. So this one, this is step two. This is when we have the adjusted gross income and are trying to figure out our taxable income. So this 83,000 of our adjusted gross minus our standard deduction, it gives us $59,000. Woof! Okie dokie. Now, from this, we need to figure out what our taxes owed are going to be. Now, this, I'm just going to call this a little black box right here in step three, because we're going to learn how to calculate all this later. But right now, we're just trying to figure out what the system looks like. So in this one, our taxable income, we're going to calculate the taxes, and this is going to be based upon what the tax rate is for different amounts of income. And then afterwards, we get our taxes owed out. So let's say that this just goes through, let's say tax, where we calculate the tax. It goes through, and let's say that maybe we figure out that the taxes owed on $59,000 is going to be $6,699. Okay, that's pretty cool. Well, that's a lot of taxes owed. Maybe we should consider having some credits. Okie dokie. Well, let's say we have $6,000 in credit. We get the earned income tax credit. We get a bunch of other credits, maybe some credits for daycare expenses, maybe some other things. Let's say that we have $6,000 in credits. Well, that means our taxes owed minus our credits equals our total tax payment. So maybe our total tax payment is $699. Well, what do we need to do? We need to compare that to our withholdings. How much money was held out from that $85,000 through the year? So let's say that maybe we had $2,000 that was held or withheld from our paychecks and sitting in a bank account with the government, right? Okie dokie. Well, once we have that, we're comparing that $2,000 to the $699, which leaves us for a final tax payment of $1,301. But notice that this is negative. So this is actually a refund in this situation. Ooh, I don't want to leave that there. So in this case, we get $1,301 back. Okay, that was kind of fun, right? Like, can you believe you pay someone to figure that out for you when you could have all the fun of figuring it out yourself? Okay. Well, then sometimes you might be wondering what's better, having a deduction or having a credit. So let's think about what that really means in the big picture. Well, tax subsidies can be offered in one of two ways, as a deduction or as a credit. Tax deductions are the amount by which taxpayers are allowed to reduce their taxable income through spending on items such as charitable donation or home mortgage interest. So that's that. Here, I can come back. It's this portion right here, right? So we have the deductions of what we spent for things such as like putting money into your HSA, or what we have down here, which are standard deductions or itemized deductions. Okay, or we could have credits. Credits are actually money that reduces the amount of taxes that you might owe, right? So the taxes that you might owe right down here. Now, governments can probably decide one of these two options, and it's kind of difficult to figure out which one to always do. So let's have one example where we decide to, let's say we have $1,000 and we're deciding on whether to put that as a deduction or as a credit. And let's say we have the exact same person. Well, maybe if they have 85,000 minus this 2,000, and then we have the 83,000. Let's add this 1,000 here. So maybe minus $25,000. Okay, well that gives us 58,000 for our taxable income. Well, taxable income, we then need to take the average tax rate and the marginal tax rates. Just trust me on this one. We're going to figure out how to calculate it, but you really don't want to do the math on top of this math. So let's say that we end up having 6,450 for your taxes owed. Then we still have this $6,000 credit. Notice that at this point we have I can just do back. Isn't that just amazing? Technology. So our taxes, or our total tax payment would be $450. Well, let's look at the other situation. Okay, let's see that we have the other situation where maybe, we'll do this one in blue. We do it as a credit instead. So in this one, we did it as a deduction. We added $1,000 to our deduction. But in this one, let's add it as a credit. So we have the $85,000 that we're making. Cool. $2,000 to the HSA. So we have 83,000 left. Then let's subtract out the 24,000 for our deductions. So we have 59,000. Black box of tax. 6,699. Okay. Now here's the fun part. What if instead of that $1,000 being a deduction, it's a $1,000 credit? Well, then we're doing minus 7,000. Whoa, minus 7,000. What does that equal out to? $301 negative. So they actually owe you $301 now? Okay, so the same $1,000 is being offered as either a deduction or a credit. Notice that a deduction reduced the amount that you owe. It reduced your total tax payment. But what about with a credit? A credit actually reduced it by significantly more. So when the government's deciding which one to offer, they need to think about what sort of people might be looking for this, right? Is it like a business owner and maybe we want to give them a deduction, but we still want them to have a fairly high tax bill? Or maybe is this like a struggling single parent of 4 kids that we're trying to help reduce their tax bill by offering them a credit that might be more impactful for people with lesser amounts of money, right? It's all very relative and it depends upon the situation. So governments have to decide when we're making our plans to whether we put things as a deduction or a tax credit. Right, so there's also 2 key features that come along with tax rates. Notice when I was taking you through the steps of kind of calculating taxes in our head, we did not talk about what it means to have marginal or average tax rates. I had just given you the amount that went along with that tax level. But maybe instead, let's sit down and let's think about marginal and average tax rates. So in the United States, we have marginal tax rates, which are the percentage that you pay on the next dollar that you earn. In the United States, these marginal tax rates can go anywhere from in between 10 and 37%, though that might be subject to change soon, listening to a lot of different proposals. Then there's the idea of average tax rates, which is just the percentage of your gross income that was paid in taxes. So let's see what that would look like. Let's go ahead and try to calculate some information for someone. So let's say, here, let's start a new one, Let's say that we have one person, and this one person, let's say that this is Eddie. Oops. Eddie's the name of the cougar on campus, the mascot. I like to know that. I think that's pretty cool information. And let's say Eddie makes $80,000. And then let's say that Eddie has 8 children. Okay, cool. Well, this gives us some information. Let's try to figure out average and marginal tax rates. So in this case, let's start with our first example. Let's just focus on this first statement right here because we're about to learn a couple different things about average and marginal tax rates. So let's say, oh, let's hope that I can draw this. Let's think about the total amount of money that Eddie would have in this situation. Eddie has $80,000, right? Okay. Well, this $80,000, not all of it's going to be taxed at the same rate. Let's say that maybe in this society, the first $10,000 of anyone's income, so let's say $10,000, up until that point, it's taxed at 0.10. So this is your 10% tax rate. It's the one that you tend to have on your earliest dollars earned. So this one's going to be the same as, let's see, 10,000 times 0.10. This comes out to $1,000 of taxes on that first $10,000. Okay, all right, then let's think about maybe the next 20,000. So here, light blue, the next 20,000, so up to $30,000. Maybe this is taxed at 0.15. Notice that the rate of taxes are kind of increasing the more money that you make. All right, so maybe for this next $20,000, because it's the difference in between 10,000 and 30,000, the tax rate is 15%. So this comes out to what? No, that's right. $3,000. Okay, let's keep going. We're on a roll. We got this. So maybe for the next $30,000, right? So all the way up to 60,000. Maybe this marginal tax rate is 0.2 because our marginal tax rate is increasing, right? So this difference between 30,000 and 60,000, that's $30,000 at a tax rate of 0.20. This is $6,000. Okay, then that means that we still have this difference in between 60,000 and 80,000, right? Well, maybe everything over 60,000 is taxed at a rate of, let's say, 0.30. So this remaining last $20,000 is taxed at a rate of 0.30, which that also comes out to $6,000. Okay, so let's break down some pieces here. Well, we know our marginal tax rates is like this column right here. It's how much that next dollar is getting taxed. So my $5,000, it's getting taxed at 10%. My 22nd $1,000, I guess 22nd thousand. Yeah, that makes sense. 22000. That's taxed at a rate of 0.15. 57,000 would be at a rate of 0.2 because they fall into these different categories. That next dollar, the percentage of it going to the government, that's equal to this marginal rate. Now we have the marginal tax rate, but we also need to know the average tax rate, right? So our average tax rate this is equal to the amount that we're taxed. So let's see. We have 1 plus 3 is 4 plus 6 is 10, $16,000 in taxes in this situation. So we have $16,000 in taxes over $80,000, which was our entire gross income. So this average tax rate for this individual would be 20%. Well, notice that the highest marginal tax rate they pay is actually 30%. But that doesn't mean every single dollar that they have paid gets taxed at 30% when they're in that tax bracket, because the first 10,000 gets taxed at 10%. The next 20,000 gets taxed at 15%. These taxes increase the more money there is, which means the average tax rate might actually be below what the marginal tax rate is. Well, notice in this first part that we had talked about this first sentence, Eddie making $80,000. What we didn't talk about was also the second part of the sentence, Eddie has 8 children. Okay, so we need to think about what might be happening here. Maybe that there's some sort of deductions that happen. Notice or remember, this is something interesting to know, the standard deduction differs by the amount of children that someone has, right? Or other sort of things related to their deductions. So let's try this again. Let's say that for each child, there's a $4,000 deduction. So if he has 8 children, this is $32,000 that are not being considered when we are calculating what his average and marginal tax rate should be. So when we get to the black box part, the part where we're figuring out his taxes, we would have already taken away this deduction. Okay, well, let's think about this. Let's say that, let's have like the little status bar again, that we have 60, no, what is that? No. 80,000 minus 32. Oops, I accidentally, no, bring back the box. I am just not good at this. This gives us $48,000 after we take out this deduction. Well, now let's calculate his average and marginal tax rate. So much like the first one, for the first $10,000, he's taxed at a rate of 0.10. So for this $10,000, he's taxed at a rate of 0.10. You know, it's a 10% marginal tax rate. So it's $1,000 to taxes. Okay, all right, fair enough. Then let's do the next. Okay, all the money in between $10,000 and $30,000 is taxed at a rate of 15%. Okay, between $1,000 and $30,000, this is taxed at a rate of 0.15. So that means the $20,000 in between $10,000 and $30,000, that's taxed at a rate of 0.15. This is what? $3,000. So far this is looking pretty similar, but this is where it starts to get different, right? Because after $30,000, all the money in between $30,000 and $60,000 was taxed at a rate of 0.20, right? So 20% marginal tax rate in between $30,000 and $60,000. We don't have $60,000 that we're talking about on this side. We have this remaining amount of $18,000, which will be taxed at this rate of 0.20. So we have what? 18,000 times 0.20, which that's going to be 3,600. So that means that in this situation, these are the marginal tax rates. So if he had earned one more dollar, it would have been taxed at 0.20. While in the first situation, before we accounted for the deductions of children, he would have been taxed at a rate of 0.30. So in this, the total taxes owed are what, 7,600? Notice that that is very different from 16,000. Now let's calculate the average tax rate. Average tax rate. Okay, in this one we have 7,600 divided by 80,000. His tax rate in this one is about 9.5% for the average tax rate, which is just the total amount that was actually possible to be taxed on, so the taxable income. So the taxes owed divided by taxable income. Notice that there is a drastic difference in what these amounts are, right? Isn't that kind of cool? I think that's kind of cool. That's pretty neat right there. That's how sometimes people can actually have average tax rates that are below any of the marginal tax rates, because there's a lot of deductions that are calculated in when we're trying to figure this out. Isn't that cool? Isn't that pretty neat? I'm going to give you some similar situations on your homework, and we're going to go through some similar situations in class. So that's the idea about your marginal tax rate and your average tax rate. Okay, I gotta shuffle some things around because the little drawing tablet takes up so much space. We're going to need this back. Okie dokie, let's go to the next one. So we got to think about fairness and equity, right? Because we kind of have two goals when it comes to taxes. We don't want to like screw anybody over. We would like the idea that there's like vertical equity, right? It's the principle that groups with more resources should probably pay higher taxes. So vertical equity is the idea of like really, really rich people should probably pay more in taxes than really, really poor people who can't afford the taxes. Okay, That's the idea of vertical equity. Then we have the idea of horizontal equity. This is the principle that similar individuals who make different economic choices should be treated similarly by the tax system. If you have two people who are making $100,000 and one spends his money at the dog races and one spends his money like doing charity work or spending it on different sort of clothing items, that these people are still relatively similar. They're still similar individuals who just make different economic choices on what to do with their money. So we need to treat them similarly by the tax system. So with vertical equity, we have three different types of taxes. You've probably heard about the progressive tax a lot because it's something being debated in Illinois right now. I think it's actually like on our ballots. So the vertical equity, if we're going to have that sort of system where very, very poor people pay a little bit of taxes and very, very rich people pay a lot of taxes, it typically requires having a progressive tax system. So progressive taxes are tax systems in which the effective average tax rate goes up with income. Now, this isn't necessarily the marginal tax rate, it's the effective average tax rate. So as someone makes more money, this tax rate that we're calculating at the bottom does go up. The thing is, we had two situations here where Eddie makes the same amount of money, but the deductions were different. So that's something that we have to consider when we start to develop horizontal versus vertical equity. So with progressive tax systems, average tax rate goes up. Proportional tax systems just say, you know what? We're not changing of income at all. Everybody's paying a flat 20% tax. Random fact, the IRS has a plan. I don't know if I told you this or the 112's this. If you've already heard this, I'm sorry, you're going to hear it again. But it's a 273-page contingency plan that the IRS has, that if there's an entire economic fallout in the United States, just for some reason our system of government completely collapses overnight, or there's a nuclear fallout or some other major disruption to the system, they have a 273-page contingency plan to get everybody back online in paying taxes and collecting taxes and processing taxes within 12 hours. Oh, we're not going to have internet in that sort of situation for a majority of people, but they will be collecting taxes within 12 hours. I just think that's fascinating. And one of the parts of their plan is if everything just blows up, we don't know anybody's tax records, we don't know anything about anyone, what they're going to do is just have like a flat 20% across the board sales tax until they can start to develop the system better again. A flat across the board 20% sales tax being the only tax, well, that would be a proportional tax system because all taxpayers end up paying the same proportion of their income, right? So I think that's kind of neat. The other one's regressive. So regressive is the idea that the effective average tax rate falls with income. So it's the idea that like maybe poorer individuals pay a larger percentage of their income, and the more money that you make, technically you make more taxes, but you're not paying a larger percentage. Maybe you're actually paying a smaller percentage. With different sort of tax loopholes, even progressive systems tend to end up being regressive systems over time because some people are able to take advantage of the system in different ways. These are the three different types of vertical equity that we need to think about. Now, there's lots of applications in this political process of trying to measure tax fairness because it's really, really difficult, right? Fairness is an ambiguous term. I can't tell you like, yes, that tax system's fair, yes, that tax system's not fair. That's very difficult to do because what really is fairness in the relative sense, especially because some things are completely difficult, right? Why do marriage taxes exist? Which is the idea of marriage tax is the idea that your tax bill sometimes goes up when you get married. Because if we're still maintaining horizontal equity, it's impossible to have perfect vertical equity. If we maintain perfect vertical equity, then it's not possible to maintain perfect horizontal equity, and it can fall apart. And that's something that we have to think about as our fancy public tax economists. So let's consider an income tax, right? So President Bush proposed this tax bill and he signed into law in 2003. What it was 40% of the taxes cut ended up being for the top 1% of people, right? But that top 1% of people already paid 38% of the income taxes. So the total amount of money that comes in from income taxes, 38% was coming from just 1% of the population. And they pay only 30% of all taxes due to other tax revenues being collected from proportional type taxes. Here's how they can pay 38% of the income taxes, but only 30% of the overall taxes. because there's some proportional taxes such as sales tax. Well, sales tax on goods and items, let's think about who spends what money. Let's have a family with $15,000 a year and another family with $500,000 a year. The family with $15,000 a year, every month when the check comes in, you go to the store, you buy all the things you can, you're spending almost every dime you have on goods and services that you need right there to survive. So you end up paying sales tax on all those things. So all of your $15,000, you end up paying a lot of taxes on. Well, let's look at the $500,000 household. They're not actually buying all that much compared to $500,000, right? No one making $500,000 goes out and buys $500,000 of stuff in a year. They instead maybe buy $30,000, $40,000 worth of food and items and clothing and stuff, and the rest of it, the wealth goes into the stock market or goes into savings. Well, that means that they're only paying sales tax on a smaller percentage of their income, because only a smaller percentage of their income gets spent on things that have sales tax, as opposed to the poor family, which a large amount of their income on a monthly basis goes into things where they're going to have these sales taxes. Because if you're making $15,000 a year and you're feeding a family, you're not putting in money to savings probably, right? So that's how they're able to pay 30% of the overall taxes, yet 38% of the income taxes. So with this one, it would actually, or with what President Bush did, is they ended up cutting a lot of these taxes for the top 1%, but then they had an average tax cut for lower income families by about $1,549 each. So that's kind of interesting. We got to think about why was that, and how does that figure in with progressive tax systems versus proportional tax systems, and we have this thing called Haig-Simons. So we have this idea of comprehensive income. And Haig-Simon comprehensive income defines your taxable resources as the change in your individual power to consume during a year, right? It's the idea of trying to figure out what kind of items should we be taxing. So, because in that case where we only tax the sales tax, well, then the poor families disproportionately pay a lot of it. A good example of this is the idea of gasoline tax, right? So we pay gasoline tax because it helps to maintain the roads, and the money goes in to maintain the roads that are damaged by cars driving on them. But what about electric vehicles? So Illinois actually has a yearly fee for electric vehicles, but most states do not. So you have all these really high income families that are switching to electric vehicles who are no longer paying that gas tax. So they're still damaging the road, but they're not paying the taxes that are supposed to go fix the road. Who does still pay those taxes? Well, it typically is more moderate to low income homes that hadn't switched to electric vehicles. This disproportionately puts the tax on these lower income households. So these are things that we got to think about when we're designing taxes. Is that a good idea? Like, maybe not, because the people who are using the roads aren't necessarily the same people who are paying for the roads. So the Haig-Simon comprehensive income definition defines taxable resources as the change in an individual's power to consume during the year, which means that we have this idea of potential annual consumption, which is just all the stuff that you buy in a year plus any increases to your wealth. It's the idea of taxing you not only on the money that you spend during a year, but let's think about that rich and poor family again. The poor family would be spending a lot of their income. The rich family might be putting a lot into savings, or they might be putting a lot into wealth building assets, or they might be putting a lot into housing. It's the idea of both taxing on all the stuff that this upper middle class or rich family buys, plus the increases in their wealth for the things that they own that have appreciated in value. The thing is, this is really difficult, right? It's very easy to know what a paycheck is and to try to take a percentage of a paycheck, but how do you know about the appreciation of art? Or how do you think about the ability to consume goods and services, right? Or what about non-consumption expenditures? How do you deal with charitable giving? There's a wide variety of things within this income definition that we don't necessarily understand, but yet we still have all these moving pieces that we're trying to put into one comprehensive tax system. Okay, so let's think about some deviations from Haig-Simon. So the idea of, okay, we're going to start taxing everyone based upon how much stuff they can buy and how their assets appreciate, right? So any additional ability to spend that they have. So this kind of promotes horizontal equity because it starts treating all income equally. It's not just your income from your paycheck, but it's also just the value of wealth that you have from like your house is being valued at more, or your car's being valued at more, or your art being valued at more, even when you pay like $1 million for a banana that's duct taped to a wall, right? True thing that happened this year. So one reason why we might deviate away from this though, because it does promote this horizontal equity. But maybe there's times where we should maybe think about circumventing them in other ways. Some reasons for this might be property and casualty loss. Okay, what happens if your entire home burns down? So you are having to spend a lot of money, but it's on replacing things that you had previously. Or medical expenditures. You're spending a lot of money, but it's on something that is costly and damaging you and affecting your ability to make money in the future. Or your state and local taxes. You've already paid taxes, so why should you also have taxes taken out above and beyond what you've already been paying, right? Should there not be credits for this? So there might be deviations due to the ability to pay. In all of those situations, if your house burns down, if you get hit by a car, if you got, you paid a ton of state and local taxes, you're going to have less ability to pay. And that's something that we have to consider when we're putting together all these pieces. There's another really good reason for sometimes deviating away from the idea of Haig-Simon Haig-Simon income, right? And that's the idea of charitable giving. So charitable giving is likely underprovided, right? We don't have enough people who go out there just out of the goodness of their hearts to help people compared to what the social benefit actually would be for them doing it. But we want to incentivize that sort of behavior. So even if we have two people who are making the same amount of money and have the same appreciation of assets, if one of them is giving to a homeless shelter, instead of buying maybe something that might be productive for them later, like stocks or cars or something like that, if they're instead giving to something that might be an unproductive asset, but one that's good for society when we start looking at the marginal social benefit versus the private benefit, then it might be something that's underprovided that we would like to incentivize more. This is why we give tax breaks for donating specifically to underrepresented or non-for-profit groups that may not get enough funds through other resources, right? So there's an efficiency consideration that we have to do. Let's go all the way back to the idea of tax deductions and tax credits, because we're working all this together, right? So let's say that we're considering replacing charitable giving deductions with a tax credit up to $1,000, much like we had shown earlier. So let's say that we'll give a credit up to $1,000, right? If we give a credit up to $1,000, and that means for every $1 that someone decides to give to charity, they get $1 off their tax bill. And this can go up to $1,000. Well, we would sometimes like people to donate more than $1,000, right? So for people giving less than $1,000, the tax credit's great for them because they're like, oh yeah, this is awesome. I'm getting money off my tax bill. But they're donating less than $1,000, so it's a 1-for-1 match for them. But what about the person who wants to donate more than $1,000? And a tax credit may not be right for them. Sure, they're getting a 1-to-1 payment back for that first $1,000, but everything after that, they may not necessarily get a benefit from. Instead, we might want to subsidize them on the idea of their deduction and maybe give them a percentage off on their deduction or something like that to incentivize letting them write off a larger amount, which may only adjust their tax bill a little bit for each dollar, but at least it has continued benefit for each additional dollar. So policy preference is really going to depend on kind of the nature of the thing that we're trying to subsidize. So is it we're subsidizing childcare? And that we tend to use credits. Is it we're trying to incentivize donating to homeless shelters? In that case, we might end up doing deductions because it's something that we would like to have larger amounts of, right? And how important is it to achieve some minimal level of this behavior? Do we want everybody to do $1,000 and stop? Or would we like to have some sort of system where people may not donate at all, but the people who do donate tend to donate a lot? That's something that we need to consider about when we're considering the efficiency of deductions versus credits. Now, we also have to think about equity in these situations, right? On vertical equity grounds, tax credits are much more equitable than deductions because it's just giving $1,000 to everyone, right? But the value of the deduction rises with one's tax rate. So the higher and higher your tax rate is, the more in $1,000 can really benefit you that you may not be able to get from somewhere else. So this could actually turn out to be a regressive tax system where that $1,000 coupon could matter more or be more effective compared to the average tax rate. Oh, sorry about that. Compared to the average tax rate for a family or individual with a high amount of income relative to a family with a low amount of income. So this could end up being a regressive tax system. And that's what happens a lot with the deduction side. But then there's also the credit side, the idea of what are we trying to incentivize now. So deductions we tend to use if we're trying to prioritize getting high-income families or high-income individuals to give money into something. Credits are good when we are trying to help out a low-income person right then. That's why we have the earned income tax credit. We have different tax credits for students. We have different tax credits for childcare for really impoverished households. We have tax credits for being able to buy healthcare. We have tax credits for being able to buy childcare, a bunch of other things. These tax credits, I think I might have mixed up something earlier, by the way, and if I did, I'm really sorry, but I'm too tired to re-record this. Credits are really, really great if we're trying to have a progressive tax system and we're trying to get a minimal level of work into something, or we're trying to get like a minimal level of childcare or a minimal level of healthcare. Tax credits great for that. Deductions are really great when we're trying to incentivize maybe less people to do it, or people who might be more likely to itemize, and we would like them to support large sweeping things. So the idea of donating lots of money to charity as a proportion of these larger amounts of money, then sometimes deductions are better. So it depends on what we're trying to focus on. Whew. With that, go ahead, get up, stretch your legs, because we're going to start talking about tax incidents, and I've decided that I am splitting this into 2 videos because it is too long for one. I will see you all soon. All righty, stretch your legs, come back to the next one.